Regulation A, often called Reg A or Reg A Plus, is one of the most significant capital raising tools available to private companies today. It sits between traditional private offerings and a full IPO, making it a powerful option for companies that want to raise larger amounts of money while staying private or preparing to go public. Think of Reg A as a bridge between the private and public markets. It offers greater investor access than the Reg D or Reg CF, but with more structure, reporting, and transparency than smaller exemptions. Let's break down exactly how it works. Regulation A comes in two tiers. Tier 1, raise up to $20 million per year. Audited financials, not required, but reviewed financials are. No ongoing SEC reporting after the offering, but you must comply with state blue sky laws. Investors can be accredited or non-accredited. Marketing is flexible once the filing is cleared. Tier 1 is used less frequently because state-by-state qualification can be time-consuming. Tier 2, raise up to $75 million per year. This is the version most companies refer to when they say Reg A Plus. Tier 2 requires full audited financial statements, ongoing reporting, annual, semi-annual, and current events, SEC qualification before raising, no state-by-state qualification. Investors may be accredited or non-accredited, but non-accredited investors are capped at 10% of their income or net worth unless the securities will be listed on a national exchange. Tier 2 is the closest thing to a public offering without actually being public. Now let's talk about why companies choose Reg A. The biggest advantage of a Reg A is the ability to raise large amounts of capital from the general public, not just accredited investors, up to $75 million per year. That's significantly higher than Reg CF's $5 million limit and more accessible to non-accredited investors than Reg D. Companies often use Reg A to fund national expansion, launch new divisions, increase manufacturing or service capacity, acquire competitors, prepare for listing on the NASDAQ or the New York Stock Exchange, build a broad shareholder base prior to an IPO. Some companies even use Reg A to create consumer investor ecosystems where thousands of everyday supporters become part owners of the brand. Let's discuss the process. To conduct a Reg A offering, a company must file a Form 1A with the SEC. This document includes financial statements, description of the business, risk factors, use of proceeds, details of the offering, management background, exhibits, and material contracts. The SEC reviews the filing and may issue comments or questions. Once all the issues are resolved, the SEC qualifies the offering. Only after qualification can the company begin accepting investments. This is fundamentally different from the Reg CF and Reg D, where companies can raise money without prior SEC review. Reg A requires review because the audience is broad and includes everyday investors. Now let's talk about marketing. Reg A allows companies to test the waters before their offering is qualified. This means they can advertise, gauge investor interest, and build a reservation list. However, they cannot accept actual investments until qualification. This is powerful because it allows companies to validate demand before investing heavily in the offering process. Once qualified, companies may broadly market their offering using social media, television, internet ads, webinars, events, and press releases. This level of marketing freedom is extremely rare in private markets. Now about ongoing reporting. Tier 2 companies must file annual reports, the Form 1K, semi-annual reports, a Form 1SA, current event reports, a Form 1U, and any exit reports if they suspend reporting. This level of transparency makes Reg A issuers more credible and more attractive to institutional investors compared to completely private companies. For many companies, Reg A is a strategic stepping stone to a national exchange listing. Finally, let's examine how Reg A fits into the broader capital strategy. If Reg D is for accredited investors and Reg CF is for broad retail participation, Reg A is a scaling vehicle. Companies may start with Reg D to build early shareholders, move to Reg CF to activate community support, and then launch a Reg A offering to accelerate growth and prepare for an eventual IPO. This latter approach is becoming increasingly common as private companies seek out access to capital without giving up control.